All right, let's jump right into this explainer. Today, we're covering a truly fascinating charting analysis of the silver market, or XAUSD. And honestly, we're looking at some of the most extreme technical setups you'll ever see. If you follow precious metals, you already know the volatility can be intense. But what the underlying structures are whispering, or, well, actually shouting on the charts today, it's something else entirely. This is a critical moment for silver that could literally define portfolios for years to come.
Right now, we're standing at a massive crossroads. The data points to two completely opposite extremes, and today we're going to break down exactly how both of these wild scenarios could unfold. On one hand, we have a setup pointing all the way up to the stratosphere at $175, or a structural pitfall that could drag prices down to $21. It sounds almost impossible for a single asset to have such a polarized outlook at the exact same moment, right?
And hey, even the analyst behind this acknowledges that the bullish target sounds absolutely insane. As they put it, people might say, KG is crazy. How are we going to reach this high? But here's the thing. We're not dealing with emotions or gut feelings here. The math behind this technical cycle is telling a very specific story. We're strictly following the math. And right now, that math is screaming.
So let's start with section 1, the big silver cycle. We really need to zoom out and look at the macro framework first.
The entire foundation of this analysis relies on Elliott Wave theory. Specifically, we're looking for an Elliott Wave impulse, which is a 5-wave directional move, waves 1 through 5, that indicates a super strong market trend. You see, market trends don't just move in a straight line, they move in waves. A true, powerful bullish trend manifests as this 5-wave impulse, 1, 2, 3, 4, 5. It's essentially the heartbeat of a bull market. And right now, the overarching bullish thesis hinges on the idea that silver is currently mid-stride in one of these massive 5-wave moves.
Now this brings us to the rule of alternation. In Elliott Wave theory, this rule states that if Wave 2 is a shallow, sideways correction, Wave 4 is expected to be a deep, aggressive correction. And this brilliantly explains why we're seeing such a steep drop right now. Because the previous Wave 2 was a shallow, sideways flat, Wave 4 has to alternate. It literally cannot repeat the same behavior, therefore it has to be deep and aggressive. It can be painful to hold through for sure, but structurally, it's doing exactly what it's supposed to do.
Moving right along to section 2, the bullish dream scenario. Let's analyze that upside potential.
Let's map out what the analyst calls the most beautiful scenario, basically the path where everything aligns perfectly. Step 1, a massive Wave 3 unfolds, pushing us initially to $87.01, aligning perfectly with the 1.618 Fibonacci extension. Step 2, a deep, later cycle Wave 4 correction, potentially revisiting the psychological $100 mark. And finally, Step 3, a massive, explosive Wave 5 surge. The math just scales up and up as these cycles compound.
If that Wave 5 extends and takes the 1-to-1 Fibonacci level, we are looking at a staggering $175 cycle target. That would mark a massive new all-time high. It's just a breathtaking number. Structurally, if this target hits, it means Wave 5 actually becomes longer than Wave 3. In wave theory, that confirms we're in a massive, prolonged impulse cycle.
But we have to look at the other side of the coin. Section 3, the bearish reality check. Let's explore the downside risks.
We can't just be dreamers here, right? We have to step back and look at the alternate structural reality at this exact same junction. We're comparing a 5-wave impulse against an ABC zigzag. What if that 5-wave push isn't what we think it is? In plain terms, a true impulse means the trend is your friend and it's just getting started. But if it's a leading diagonal zigzag, well, that means this whole upward rally was just a fake-out, a preliminary wedge that will inevitably break downward in a massive ABC correction before any true macro growth can ever continue.
In that bearish reality, the minimum target for the subsequent Wave 2 correction hits the 0.138 Fibonacci level, which drags silver all the way down to a very low $21. Just let that sink in for a second. $21. From the exact same current price action, a slight structural misinterpretation could mean the difference between aiming for $175 and crashing back down to a fraction of the current value.
Which brings us to section 4, navigating the crossroads. Here is the immediate setup.
Because the gap between $17 and $21 is just so vast, we really have to navigate these immediate crossroads scenarios. Even if we're ultimately bullish, we might not get an easy ride straight up. Scenario 1 is a WXY zigzag. This is essentially a frustrating sideways double correction that heavily tests buyers' patience, delaying the wave 5 push. Scenario 2 is a larger AB correction that creates deeper downside pain before the real sustained trend eventually resumes. The market just isn't going to hand us the answer on a silver platter.
Plus, the gap down to the invalidation level at $34 is still very, very large. This massive gap is exactly why the analyst expects this wave 4 correction to be extremely deep before finishing its structure. When your invalidation level, which is the exact point where the entire bullish thesis completely falls apart, is that far away, the market has a ton of room to breathe, correct, and shake out weak hands without actually breaking the overarching bullish trend.
Now let's zoom in a bit for Section 5, the micro-level breakdown. A quick look at the short-term view.
So looking at the 1-hour chart probabilities, despite that massive bullish potential we just walked through, the immediate micro-level probabilities still favor the bears, 60-40. Why is that? Well, because the structures indicate we need one more drop to properly finish the current corrective phase. We're fundamentally still waiting for that final low to print before the structure is actually complete.
For this week, the immediate market triggers are highly actionable. A bullish breakout happens if we take $61, which opens the door right up to $65. On the flip side, a bearish breakdown occurs if we lose $58, confirming a push to lower zones. Until those levels are decisively broken, the macro status remains structurally bearish.
So, are we going directly for wave 5, or is a double crossroad ahead? It's incredibly easy to get swept up in the dream of $175 or the sheer terror of $21. But as we've seen in this explainer today, the key is this. Can you set aside your emotions and simply watch the structure? Keep an eye on those trigger levels, respect the invalidation zones, and let the market tell you which road it's taking. Thanks for joining me today. The structures are set, the triggers are clear, so which side of history will silver choose?